The Rebel Capitalist Show.
I was actually on Chris Cole's website. I've been doing a lot of reading. He's got a new paper. Everyone's very familiar with the dragon portfolio and the allegory of the hawk and serpent. But he actually came out with another paper called The Rise of the Dragon, where he actually does back testing with the dragon portfolio for 2020 and compares how it did relative to like a risk parity portfolio, the 60-40 portfolio that most people know about through their financial advisor. And it's just staggering how well the dragon portfolio did. I think it was up like 52% or something like that. He's got the numbers in this most recent report. But anyway, that was kind of right on my mind. So we were talking the other day and you said, well, maybe let's do a video for some people who might be new to options, or maybe some people that have a little bit of experience on how they could kind of build this into their own portfolio, this concept of the dragon portfolio, while at the same time maybe giving them some information as to how they could use options to also create cash flow, which is something that I'm always interested in, being a real estate guy. So that's why we've got you here today. So I'll just hand it over to you so you can teach us how to work the dragon portfolio that did so well in 2020 and make a little bit of cash flow from these options.
Now, I want to talk about selling puts for a second. And so selling puts is basically when you sell a premium, you undertake the obligation of buying the security. We are now the insurance company. So before we were buying the insurance we were buying the put to protect the downside risk. But there are different assets that we could turn around and generate the return, because insurance companies more often than not end up making money. Obviously, there's always that disaster, and a company has to make this big payout. But it's one of those things where they're consistently making money for long periods of time, and then suddenly a market event occurs and the insurance company loses, right? But over the long term, they're making money. And selling puts has many of the same characteristics. We're selling that downside insurance. Now, what I want to do is do an example of this. So let's just use Bitcoin, but let's just say you say Bitcoin's a little expensive, but if, let's say, by August, Bitcoin is trading, let's say 20% down, and you say down at $8.50, I'd buy it, right? So that's it's trading at 10.25.
Well, okay, this is the Bitcoin Trust. Okay, got it.
That Bitcoin Trust, it's trading at 10.25. And you say, if it drops 20% and it's trading at 8.50 or something like that, I would buy it, right? Well, that $8.50 put is paying you upfront $1. So you basically are going to be paid over a 10% premium which means that your break even is actually $7.50, because if you're obligated to buy it at 8.50 and you made $1 income guaranteed, your break even is $7.50. And so now you're basically saying, am I willing to own this $2.50 lower than where it's currently trading? If the answer is yes, then you could turn around, grab that income premium, and if it never goes down there, you just made yourself a 10% return.
Yeah.
Right? Like,
what's the speculator thinking on the other side of that?
Well, no, it's not a speculator. It's an insurance. Someone who wants the insurance. Someone who put their entire life savings into Bitcoin and wants to have tail risk, and that if it collapses, that they haven't lost.
Covered.
Yeah. So he said you're selling insurance. That's how much tail risk insurance is costing for someone who wants to hedge out the downside risk of Bitcoin. Okay, and you, on the other hand, are saying, I'm willing to buy it down there.
I'm willing to buy it at that price. So their concern is that it goes below $8.50. And so if it goes to $5, you're saying, okay, I'm still going to buy it at $8.50.
Yeah. You basically you are obligated to buy at $8.50. Yeah. You're the insurance company.
So they're just putting in a floor to how much they can lose if it's trading at $10. They're saying, okay, I can't afford to lose anything more than if it goes than $1.50, basically.
Right.
Yeah. Okay.
And so So in this scenario, you basically are selling that put for an income to give someone insurance, and they themselves paid you the money because they wanted to buy the insurance.
Yeah.
And when you're becoming the insurance company. Now, to me, if you have the money on the sideline and you're willing to buy it at that price, then was there really a risk? You're already getting at a considerable discount towards trading today. All you're doing is you have the money on the sideline, and you're saying I could pick up an extra $1 or 10% off of selling this put. And that's 10%, not in a year. That's 10% between now and August, like 4 months, whatever. Like you basically turning around and generating yourself a quick 10% cash flow, securing that price, right? And it's just a fabulous way of generating returns. The thing is that for most people that when they hear put selling, they are immediately intimidated by it. They basically are like, sounds scary. I heard so many horror stories about people selling puts, but covered call writing and put selling actually have the same payoff profile. So when I look at this right here and I say, when I sell a put option, am I taking more risk than somebody who owns the shares?
Mm-hmm.
And what I'll say is like this payoff profile is identical for actually both the covered call writer and the put seller. You're both short gamma. You're both have limited.
What is gamma?
Gamma is well, when you're long gamma, you're long optionality and the convexity of an option. You're getting into a little bit more of a complex topic in options trading. That's where you'll hear obviously the Charlie McElligots and all these other guys, Chris Coles talking about this optionality. But the gamma is basically the convexity that once something starts going in your favor, you start making more and more money as you become more and more right. And when you're short gamma, you're the opposite side of it. You're actually short that convexity, not long that convexity. And so without using all that fancy terms, bottom line is that what we want to just talk about here is that both covered call writing and put selling for that component of your portfolio is you are a premium harvester. And so what I want to just demonstrate this very simple comparison. We have two investors, one that buys the shares. So we have a $10 stock and a 3-month covered call is paying 70 cents. So they're making a 7% return in 3 months. Off of a covered call. So they physically buy the shares. They buy, let's say, $10,000 of the stock, and they turn around and earn a $700 cash flow upfront, as real as a dividend in your hand, right? And it's money in your pocket. Now, in the end, they have entered an obligation that if that stock is above $10, they're forced to sell the stock, but they made a guaranteed 7%. Now, at the same time, someone turns around and sells a 3-month put. They don't own the shares yet. They have the obligation to buy the same $10,000 of stock that the investor in the first scenario already bought. They're not taking any more or less equity risk than the covered call writer. In the end, there's just whether or not you own the shares first or you own the shares later.
Yeah.
It's you're taking the same underlying $10,000 equity risk, and because of put call parity, it's going to pay you the exact same 70-cent income. So in both of these scenarios, our investor is actually got the same break even, $9.30. You basically, whether you bought the stock and made 70-cent premium, you have a $9.30 break even. And if you sold the put for 70 cents and it's put to you at $10, your average cost is $9.30. The point I'm making is actually covered call writing and put selling are actually synthetically identical. There isn't much difference between them, yet many people view covered call writing to be very conservative and selling puts to be risky. And in the end, it's not. They're literally the identical strategy and are quite interchangeable. In fact, a strategy that I cover in presentations is called a wheel strategy, where basically once the stock is put to you, once you sell it, sell the put, and then the stock is assigned and you have to force to buy it, you just begin covered call writing on it. And you covered call right on it until it's they force you to sell it, and then you turn around and sell puts to buy it back, and you just sit there and you just wheel. It's a wheel strategy of just grabbing premium over and over again on the stock, rotating between covered call writing and put selling. It's an amazing way of just premium grabbing over and over again.
So that kind of sparked a question. If you're selling the puts, does the brokerage require you to have the amount of money in your account, and do they freeze it so you can't spend it? Or
So,
what prevent you? You see where I'm going with that?
yes. So this is the difference between what is known as a cash covered put and a naked put.
Oh, okay.
Now a cash covered put, you can get your account approved for cash covered put, and which they then collateralize a certain amount of cash to secure the notional assignment risk. They basically are saying you need to earmark this cash, so just in case you're forced to buy it, the money's already there. But if you have a margin account and you already have a good rotation going, you could sell the put on margin, and basically know that you have enough collateral on all the other things you own in your portfolio that if it's put to you, you can still buy it because you have enough margin.
Okay,
right?
then on the opposite side, what's preventing you from selling those shares to someone else prior to the strike, the time frame, prior to it achieving that strike price, if that's the deal that you negotiate?
You can buy and sell the options quite freely in the open market, but in order for an option to be covered or cash covered, or whether covered call to be considered covered, the stock has to exist there in your account. The moment you sell that stock, and then the brokerage will no longer treat it as covered, but will treat it naked. And then if you're not approved for that, then the brokerage will notify you that you are offside. Like they'll let you know that you're if you can carry it naked, then you could choose to do that. But the bottom line here is that this strategy is a process from which you can generate returns consistently without needing the market to be going up to make the return.